Good morning friends, my name is Sujaan. I take IPCC tax classes from KK sir, and today I am going to cover section 54B, which is the transfer of urban agriculture land and purchase of urban or rural agriculture land. But there are certain conditions which need to be fulfilled. The first condition is that only individual or HUF can claim exemption under section 54B. The second condition is that the agriculture land can be either a long-term capital asset or a short-term capital asset, and the agriculture land should be located in urban area. The agriculture land should be used either by the individual or his parents for the agriculture purpose for a period of at least 2 years immediately preceding the date of transfer. The third condition is that the agriculture land should be purchased within 2 years from the zero date. The fourth condition is about the deposit scheme, which is discussed in section 54 subsection 2, which states that where the amount has not been utilized for the purchase of agriculture land on or before the due date of furnishing of return, then the amount shall be deposited by him on or before the due date of furnishing of return in a deposit account under the capital gain account scheme 1988, and that deposit account should be deemed cost of acquisition of the new agriculture land, and the exemption can be claimed under section 54. Now, if an SSE plans to purchase the agriculture land after the due date of furnishing of return, then he shall deposit that amount in a scheduled bank on or before the due date of furnishing of return, and that amount should be utilized before the expiry of 2 years from the zero date. And now what is zero date? Now what is zero date? Zero date is the date when the original agriculture land is transferred, and due date of furnishing of return is the for assessment year 17-18 is 31st July 2017 and 30 September 2017. SSE can purchase more than one agriculture land to claim exemption under section 54B. Now, how to calculate exemption? So the amount invested in new agriculture land within zero date gets actual exemption, whereas in that we would add the amount that has been deposited in scheduled bank on or before the due date of furnishing of return, that would get temporary exemption. What we would be left with the exemption exempted amount limited to long-term capital gain and short-term capital gain. Now there are two consequences that arise. The first consequence is that when there is non-utilization of the deposited amount for the purchase of new agriculture land. So if the amount has not been utilized for the purchase of new agriculture land within 2 years from the zero date, then the exemption that has been claimed from the deposited amount stand withdrawable or is taken back. And the second is that exemption amount withdrawable is considered as long-term capital gain, and that amount is taxable after the expiry of 2 years from zero date. Now, how to calculate long-term capital gain? So, amount of capital gain that has been exempted earlier, from that we deduct the amount that has been actually utilized for the purchase of new agriculture land. What we would be left with is long-term capital gain or short-term capital gain, depending upon the capital asset that has been transferred. Now, second consequence is that when the new agriculture land has been transferred within 3 years from the date of its acquisition, so short-term capital gain will arise as the asset has been sold within 3 years from the date of its acquisition, and penalty gain would also arise because we have converted long-term capital gain into a short-term capital gain. So how to calculate short-term capital gain? So the amount of capital gain that has been exempted earlier, in that we would add the amount of capital gain that has arisen because of the sale of asset within the 2 years from zero date, and we would get the short term capital gain and that would be year of chargeability is equal to year of transfer. Thank you.